Hello and welcome to this video. In this video, I would like to share with you a unique financial model or a business model to forecast the income statement and cash flow statement of a business. This model can be used to do 1 year future forecast either for a new business or existing business. As you can see, we have two tabs here, new business and existing business. The structure of the both model is same. The ideal businesses for which this model can be used are small to medium sized businesses. For example, currently I am showing a business forecast for an electronic store which sells up to 5 products. It can be used for a restaurant business, a service industry business, like consultancy as well. But you can always add more products to the model depending upon your business model. This kind of model is ideal for quickly forecasting 1 year performance and get realistic outlook about your profit performance and most importantly your cash flow performance. Please keep in mind that this is a high level or macro level forecasting tool or a model. But you can always input more details and more factors to make this entire model more comprehensive based on your business model or type of business activities. So let's start with the overview and how to use this model for your business. First of all, you should note that colors of fonts used in this model. So the blue color fonts are for the direct hard-coded inputs throughout the model. Cell with blue color can be used for inputting values directly. So here we have direct inputs, here the first date is a direct input, and various other places we have a direct inputs with a blue color font. The red color fonts are used to change various key factors to generate scenarios in the model. These inputs are mainly drop-down selection values and they are generated using data validation feature of the Excel. So here these are the red color fonts and these are the key inputs which can be used to manipulate the model. Don't worry, I'll be explaining each of them in a moment. The red fonts are also used for error detection. So everywhere there are error checks and for that I have used red font as well. The black color fonts, which are default fonts, are used for formula values. So all the black color fonts are formulas and you shouldn't touch them unless you know what you're doing, unless you know the formula very well. The bold dark brown fonts are used for the values which are derived from a separate schedule in the model. For example, we are having 3 supporting schedules in this model: a long-term bank loan, a fixed asset and depreciation schedule, and line of credit or bank overdraft schedule. So figures derived from these particular schedules are interest on long-term loan and LOC, and also depreciation are linked here and they are represented in bold dark brown fonts. The exception to this font rule is only in one schedule, which is trade of credit or a line of credit schedule. Here in this particular scenario, even though we have a rule of inputting these colors differently for different values, here for a sake of highlighting that you have a negative cash in the particular month, I have made a number formatting using custom formatting. So whenever there is a minus figure or there is a lack of cash in that particular month, it will be highlighted in red font. So this is the only exception to our font color rule in this entire model. Now let's go through each element of this financial model. So on the top we have a key KPIs which are linked to the particular result for entire year. And we'll start with the sales. So as I mentioned before, this particular model is designed, for example, for a consumer stores which sells 5 products: mobile phones, smart TVs, home theater system, gadgets and accessories. And since this is a new business model, this is a new business, and if you're doing any business, you must have some feasibility analysis or estimate for your sales each month. So since we are starting from month of December and our actual business operation will begin in month of January 2019 and so on, so we are forecasting what would be our first year in this particular business. So before we do that, we have some analysis or some estimate for each product sales figures in a month. So this is a monthly sales we are expecting that we will be able to do as a base. At the most reasonable or most likely scenario would be this much amount of sales, which is 50,302, combining all these products. And now based on this particular base sales, since these particular sales are colored in blue, you need to manually enter your expected sales for this particular products, all these products, and also for entire month. And based on that, we'll be manipulating our future performance based on the linear or a selective approach. Now what is that? So let's go through linear sales. So here we have percentages. So linear means we have 12,000 as a base sales for the mobile phones. If I choose linear selection or linear method of forecast, and if I make the linear forecast percentage of 0, each month my sale would be same, $12,000. But suppose I'm more optimistic and I'm assuming that each month I'll be increasing the sales for mobile phones by suppose 10%, the figures will change. So based on this 12,000, 10% add on that, we'll have 13,200, and you add 10% to 13,200, we'll have 14,520, and you add 10% to 14,520 in March, we'll have a 15,972, and so on. So when you choose linear method and put your particular percentage here, you have a month-on-month growth of sales for your product, as you can see here. So you can have a positive or negative, you can have a zero as well. So if I put, for example, negative 9%, so each month based on this base sales, my sale is reducing by 9%. Since this kind of linear forecasting may not be practical in any business scenario, in real world we'll not have any kind of linear increase in sales each month. So I have given an option to have a selective sales as well. So now in selective, for example, if I choose selective for mobile phones and I input figures here, so this section, which is a blue font again, is a hard key input, so you can input figures and manipulate it. So for example, instead of 10% linear growth, I'm having a selective growth of say 25% in month of January from our base sales. So my sales expected as a base was $12,000, but I'm expecting 25% boost in the first month itself. Or my forecasted sales for this particular month would be 15,000, which is 1.3 or 30% above 12,000. But next month I'm expecting a downfall, so let's make it 25% minus. So based on 15,000, my sales will reduce to 11,250 of previous month, and so on. I input the selective percentages here and my sales will be calculated accordingly. So this is more of a realistic approach, especially when you have a seasonal sales products. For example, mobile phones tend to have increased in sales when you have a holiday. So suppose your holidays are falling in month of December and November or December, you can increase your sales accordingly. This applies to all the products as well. So if you choose selective and your input for smart TVs would be in this particular row, and then accordingly you can choose the percentage, 25 minus 15 plus 5 minus 5, 15 minus 25. Accordingly your sales will be adjusted, but keep in mind that these particular percentages are applying to the previous month, not the base particular sales, right? The base sales is only used for the linear method of your forecasting and growth. As you can see, these figures are already changing based on your inputs. So this way you can have a many number of scenarios for forecasting your sales for this particular business. So this is very comprehensive, and also I would call it a fantastic approach to forecast your sales growth in a short term like 1 year. Now below that we have a cost of sales. Now cost of sales for this kind of inventory business would involve 3 key components besides cost of sales. So if you know basics of cost of sales is derived from opening stock, you add purchases into that and deduct the closing stock. So if I unhide here, I have done same thing here. So since this is a new business, we'll have some inventory. So before you start any kind of business, you need to have some inventory. So since this is a fast moving goods like mobile phones, smart TVs, home theater and accessories, this we have to buy from some wholesaler, right? So before we start business, we need to have some form of inventory. So we have assumed here that we have a 17,037 worth of, and then that would be our opening stock for the month of January. Since this is a blue font, you have to input these figures directly, but this will be taken as opening stock in month of January. Now we have purchases here, we have closing stock. Now for the purpose of modeling, you cannot manipulate all these particular figures at the same time and have some meaningful analysis. So we can only manipulate one particular KPI. So in this case, we are manipulating cost of sales by using a GP percentage. So here we also have a base GP. So since in the beginning, as I mentioned, we have some form of estimation for sales figures, at the same time we need to have some form of gross profit percentage forecast as well. So mobile phones will be having 25.5% as a base gross profit. Smart TVs will have a 17.5%. Same for the home theater systems, 20.2% for gadgets, and for accessories we'll have the highest gross margin of 55%. At the start of modeling, we need to have some form of estimate for your gross profit as well. So we are calculating the cost of sales by reversing the gross profit percentage here. Now as I mentioned, this is inventory business, so cost of sales formula would be opening stock plus purchases minus closing stock. But since we can only forecast cost of sales, we need to forecast the other two. We have the opening stock, we have the cost of sales based on this manipulation, so we need to derive purchases and closing stock. In real world scenario, you will have this kind of figures readily available from your books of accounts. For the purpose of forecasting, we need to put some form of logic. So I have approached this kind of method where we know the cost of sales based on our models. I'm keeping 15% cost of sales as my closing inventory. This also you can change it according to your likings and according to your business. You can make it to 25% or 20% as well for each month or a different month. So here I put various percentages, 15 to 12%. So this would be my closing inventory based on my cost of sales. Now I have opening inventory, I have a closing inventory. Now I need to derive purchase. Now you already know the formula for cost of sales, right? Or cost of goods sold in this case. So the formula is opening stock plus purchases minus closing stock. Now we have a cost of goods sold, we have closing stock, and we have opening stocks. We need to apply this formula in a reverse manner to derive the purchases for the month. So here you can see the formula. First thing is I50. What is I50? Is my cost of sales. I'm reducing the opening stock and I'm adding the closing stock. So this is exact reverse of the original formula. So we'll get the purchases for the month. Now we want to double check that this is right. So actual formula I'm applying here. So for entire products, I'm taking opening stock plus purchases minus closing stock. This would amount to 35,289, which is also sum of this. So this is matching here and matching here. So this error check ensures that our overall logic is correct for the cost of goods sold. Now, if you have any kind of business, for example, if you have a consulting business for which you want to use this model, you won't need to create this kind of section, opening stock, purchases, closing stock. You'll have a direct cost of goods sold and you can manipulate it accordingly. We have total cost of goods sold now based on our percentages, and here also we have two approaches, linear and selective. So if you choose linear, for example, let's select linear, and these particular percentages are gross profit manipulation. For example, if I have a base gross profit of 24.5% for the mobile phones and I want to increase the gross profit by 10% each month. So here the cost of goods sold will be calculated reversely. So 25.5% and 10% boost in your gross profit for the month of January will increase your gross profit and reduce the cost of sales. So accordingly this figure is calculating. And this would be a linear percentage. So each month our gross profit will be increased by 10% and reduce our cost of sales accordingly based on this base GP. But as I mentioned before, this may not be the case for all businesses. Practically, this figure may not be accurate at all, or this would be a mistake if you assume that your gross profit will increase by 10% each month. So for that, we have additional scenario called selective. Now you can go here and input your figures here. So here you can manipulate the gross profit, which will be applied to the base GP. This formula is affecting directly the gross GP. So for example, in month of January, I'm assuming I will have 15% less gross profit compared to the base gross profit, 25.5%. And accordingly, this will be calculated. So all these ones you can manipulate accordingly. So this would amount to our total cost of sales. And we have a direct cost, which is custom duty, international freight, and local freight. Now, since these costs are directly related to our cost of sales, so you can say purchases, you can directly add a formula like this. So whatever your consumption was, you can apply the freight, or you can always apply the same to your purchases as well. So however you want to model, you can do the same, but for in this particular scenario, I've applied the same to cost of sales. Obviously in the real world scenario, we'll have more accurate estimation of this cost as well. If I add other direct cost to cost of goods sold, I'll have a cost of sales, which is here. And to derive gross profit, I have to subtract total cost of sales from the sales figure. Let's hide this. So 51,635 minus 39,389 will have a 12,246 worth of gross profit in month of January. And gross profit percentage is on sales. So 12,246, which is our gross profit, divided by 51,635, our sales for the month, will give us 23.7% worth of gross profit percentage in month of January, and so on. Now below that we have a operating expenditure. Now this operating expenditure is mainly fixed in most of the business scenarios, but here in this scenario I've added one more dynamic calculation which can be a practical scenario in any kind of business as well. So here the property rent is linked to the sales. So to explain this better, let's go to our ranges tab, and this is the table from which I'm deriving. So for example, all these four costs, which is property rent, vehicle lease rent, overhead, salary and utilities, which are here, are depending upon the sales volume of that month. So if our total sales for the month is less than $51,000, our property rent will be $1,800, vehicle rent will be $500, overhead salary would be $1,500, and utilities bill would be $450. But if our sale increase from 51,000 or it increase more than 51,000 but less than 55,000, all these four overheads will increase accordingly. If it goes beyond 55,000 but less than $60,000, the overheads would be like this, and above 60,000 the overhead would be like this. So by applying a nested if function here, I have calculated the overheads for this particular month based on the sale value. So everywhere I'm selecting this particular value, entire sales of all 5 products, and applying these conditions to derive the overheads, all these 4 overheads for a particular month. Now right below that we have finance cost for LOC, which is a temporary loan, finance cost for loan, which is a long-term loan, and depreciation. Since these fonts are in dark brown and in bold, they are coming from a separate schedule, which I'll explain you in a bit. Now this would amount to our total overheads, and if you minus total overheads from the gross profit, you will get the net profit. So that will conclude our income statement or profit and loss statement. Right below income statement we have a cash flow statement. Now this cash flow statement is prepared considering direct method of cash flow. So if you have some basic knowledge of finance and accounting, you should know that there are 2 methods of cash flow used in business and reporting. It is direct method of cash flow and indirect method of cash flow. But direct method of cash flow is more realistic and easy to understand for non-finance people as well. So direct method of cash flow start with the collection of your business. So in our business we have 5 products which we are selling. In this particular scenario we have 2 kind of sales. One is cash sales and one is credit sales. So cash sales is a percentage, as you can see here, and you also have a variable and fixed. So what do you mean by fixed? Fixed means each month we have a fixed percentage of cash sales out of our total sales. For mobile phones we have a 10% of our total sales would be our cash sales each month. So whatever would be our sales, for example, if you are selling 13,200 worth of mobile phones in month of January, the 10% would be 1320 and the balance would be credit sales. And this is a fixed scenario we are applying. But if you unhide this, we also have a variable scenario. So each month you can input percentage of your cash sales and accordingly these figures will be calculated. So each month you can input the figures or percentage of your cash sales and this particular figure will be updated accordingly. But before that you have to select variable, and if I choose 25%, so 3,300 would be my cash sales for the month of January, which is 25% of total sales. The balance would be my credit sales. So you have a fixed and variable, both options, which you can manipulate and create many scenarios for your business. Now below that we have a credit sales, and these are the credit days which we are offering to our customers. So in any business, if you want to do or if you want to grow your business, you need to offer some form of credit to your customers. So in our case we have total 4 blocks of credit. If I choose 0 days, it will be total cash sales, so it will be 0 credit, or you can say that customer is paying within the month. If you choose 30 days, the customer will pay after 30 days. So for example, if we had a 9,900 worth of credit sales for the mobile phones in month of January, if you give 30 days credit sales to all your customers, you'll be receiving the money same in month of February. And accordingly, if you change to 60 days, that money will be received in month of March. If you make it 90 days, you'll be receiving the same amount in month of April. So you need to manage your credit period very effectively, otherwise your cash position will be always negative and you'll be end up paying a lot of interest to your bank overdraft. So below this is a collection from your credit sales. So as I explained before, whatever your credit period is, based on this your collection will be impacted. Now if you sum your collection from credit sales and cash sales, here you will get the total cash inflow for the month in row 109 here. Now below total cash inflow we have a cash outflow section. Here we are manipulating purchases. So if you remember, we did calculated our purchases by reversing the formula of cost of goods sold. So if I unhide here, so this particular section is our purchases. So this we have to pay to our suppliers, and how we are paying is modeled here. So same like our sales, we have a certain percentage of cash purchases. So it can be fixed or variable. So if you unhide this, we have an option to do a fixed percentage of purchases, which is whatever percentage you want, like 10%, 20%, 25%. Or you can go with variable, where you have to input here, directly hard code your values here, and accordingly your cash purchase will be calculated here, and the balance would be your credit purchase. Now in ideal world scenario, and to have a best cash flow performance for any business, you need to obtain as much as credit period possible. The standard days I assume would be 60 days, and your credit period from supplier should be always more than your credit you're giving to your customers. If the case is reversed, then you'll have the worst cash flow performance from the business. So in this scenario, let's model it to 60 days for our majority of your purchases. Now here also the calculation is working accordingly. For example, if you are buying 30 days for mobile phones, your credit is 30 days from supplier, you'll be paying for the January, you'll be paying in February, and so on. If you have 60 days for the smart TVs, your 5210, which was the credit purchases, you'll be paying in the month of March, and accordingly it will be calculated. So as I mentioned, your credit period from supplier should be higher, always higher than your credit period you are giving to customer. This should create a positive cash flow performance throughout your business and throughout your business model. Now this should be your payment to suppliers, this figure, and your total cash outflow and payment to suppliers would be each month calculated here in row 137. Now below that we have a direct other cost payment and overheads and finance cost. So the direct costs are custom duty, international freight, and local freight. So custom duty you must pay at the time of you purchase or you import the product. So this you'll not have a credit from the government body, whoever is collecting the custom duty. If you have it, you can model it accordingly. But here I have kept 0 days. That means whatever custom duty you incur for the month will have to be settled in that month. So that would be your cash outflow in that particular month. Now for international purchases and local freight, you can have supplier a credit period granted to you. Here I have assumed 30 days credit from international freight forwarder and 90 days for the local freight. So accordingly, whatever expenditure you're incurring, you can pay it later on. This will increase your overall cash flow performance. Now for indirect overheads, we have 4 kind of indirect overheads. As I explained before, they are attached to your sales. For the lease rental for the property, throughout the world it is collected always in advance, but how much advance you can always figure it out with the landlord of the property. So here in this case, if you put monthly, whatever expenditure you incur will be paid out monthly, but if you choose quarterly, the landlord will be collecting your rents quarterly in advance. So if you choose semi-annually, so whatever rent you have for entire year will be collected twice in a year. So if it is a calendar year, it will be January and 1st July. Now for lease rental, you can always ask for credit from your supplier. So you can choose whatever credit you have. So if you have more credit, better, you will be having a better cash flow performance throughout the year. Now salaries and wages will have to be settled each month. So none of your employees will stay if you have a credit period with them, right? So it doesn't make sense. So you need to settle the salaries each month. Similarly for utilities expenditure, unless you have a specific scenario where you can get credit, this has to be settled each month. So it will be cash outflow. As you incur, you have to pay it out. Now below that we have finance costs from the long-term loan, which is coming from a schedule. So this interest, I'm showing it here because for the definition of cash flow from operation, you have to include interest as well. So this would amount to your total operating cash flow, or I should say operating cash outflow. And right below that in row 153, we have cash flow from operations. So this is nothing but your total sum of cash inflow and outflow. So for the month of January, we have a negative position of 12,865 because we are starting the business and we haven't collected anything from our credit sales. Now right below that in row 154, there is a KPI called OCF conversion. So how much your cash flow performance of the month is compared to your net profit. You should always try to achieve 100% of your profit, net profit, as a cash flow from operation in ideal environment. So in the month of January, we have a negative performance, as you know, because we are starting the business. But for the subsequent month, except that in the month of July, we always have a better cash flow performance than our profit, which is more than 100%. And overall also we are doing very well. Now this will be depending upon how you set up your credit period. So you have to keep that in mind and you can model this out. Now below that we have a CapEx spend. So this is more of a bank book, a scenario of a bank book for our business. So initially we have spent 87,500 on CapEx because this is a new business. So we need to bring in some capital assets. The schedule for which is down here. I'll explain you in a bit. Now any sale of asset we did will be cash inflow and repayment of loan. So this is the principal portion of the loan. This is the interest. This is the principal. So both we are settling and we are showing it separately for the purpose of deriving cash flow from purely operations, and this is the other cash flow. So that's the reason I'm separating the same. Now there is a finance cost on our LOC, which I'll explain you why it is coming. And there is a credit line inflow or line of credit inflow and payout as well. So that I'll explain you in the moment. Now this all will amount to total net cash flow for the month. So for the month of January, we have a net cash flow 3523, but most of them is positive because of we are bringing the line of credit temporarily, because from operations we did 12,865 negative cash flow. And here is the opening and closing balance of your cash, and this is the error check, which should always be 0. Now let's go to our equity and loan schedule, which is our first schedule. This is the schedule section. And we brought in $52,000 worth of our own capital and we borrowed the rest. So how I'm deriving this figure? So basically my capex requirement was $87,500 and I needed inventory worth of 17,037 as you've seen before. So sum of these two would be 104,537. So sum of these two is 104,537. That is the total capital initially I need to start this business. So 52,000 I brought in my own money, so the balance would be my loan. And the interest rate on loan is 4.5%. This is a blue font, so you can change this percentage accordingly. This is a yearly interest and total loan term is 3 years. So I have to repay this loan over a period of 3 years. Now this is the loan schedule. So this is the opening balance. Since this is a new business, this is a new loan. And I'm using a payment function or PMT function to derive the installment of the loan, which is inclusive of interest and principal. So if I calculate the interest on the loan outstanding, I'll get these figures, which we are linking in the P&L statement above, or income statement I should say. So 197 is coming from this particular schedule, from row 179. And the balance of principal in row 180 is 1563, which is the total installment, which includes interest minus interest, will get the actual principal payment of the loan, which we are showing here. So it is coming from this particular cell, or I should say row 180. And balance would be our outstanding loan and it will be carried forwarded each month. Now this is the most complex and little bit tricky to understand trade finance or line of credit, or I should say overdraft schedule. We have a percentage of 7.5% because usually any loan which is short term will always have a higher interest than the long term loan. Now, since we are starting the business, we spend all our cash in our capex and inventory. So we had a 0 cash at the start of business. This is our assumption. Now for the month of January, as you know, we have done a negative cash flow from the business in row 153. So cash flow from operation is 12,865, which total negative cash performance. And $5,000 is our minimum cash balance to maintain our business. So this figure we need all the time in our business to sustain our business, to pay our fixed commitment. Even the month is really bad and we didn't collect money or we didn't sell well, we need to have this amount of cash in our business all the time. Otherwise we may not run our operation, or we cannot open our shop even. So you can assume that this is very critical for our business to run at the basic level. Now since we need $5,000 and we have negative cash flow, so total we need is actually 17,865. So whatever negative we did plus we need positive cash, right? 5,000. So we need total 17,865. And this will be borrowing from our bankers. So we have agreed a temporary line of credit or bank overdraft that bank will finance us immediately when there is a need for cash. So we have need of cash in month of January, which is 17,865. So that will be our cash inflow here. in here, which is coming from this particular balance. So here I'm calculating what exactly I need, and it is coming here as cash inflow. That's why we have a positive cash balance of 3523 in the month of January. Now each month this will be evaluated. Whenever we have a positive cash and which is above $5,000, we don't need a line of credit, and also we have excess cash, we can pay it off. So for example, in month of February we have a positive cash flow from operations, so 20,313, and we have met our commitments, like we have paid the loan, and then whatever cash remaining we have paid off towards our line of credit, so we don't have to incur interest. So this interest of 112 we have incurred because we have borrowed this amount. So the interest is whatever loan we have borrowed, 7.5% divided by 12, so that is a monthly interest 112. So whenever we have a positive cash flow and we can able to repay the loan, we should repay in order to reduce our interest cost. So that is what we are doing each month. This is the line of credit schedule, and apart from January we don't have any balance, so interest is also nil. Now right below it we have a fixed asset and depreciation schedule. Now this schedule is a very macro level or a basic level schedule. You can manipulate this kind of schedule or prepare a very comprehensive schedule. I have a comprehensive schedule already prepared, which is called Advanced Excel model for depreciation accounting using straight line method. That is a separate product. There's an entire course on how to work on that schedule, and also you can download this schedule independently without enrolling into the course. But if you enroll into the course, you will get the schedule free. So I have link in the description of this video where you can find those schedule or that course, and you can use that particular schedule to do a comprehensive calculation for the depreciation and fixed asset addition, deletion, profit or loss on sale of assets, and many other factors. So here we have this basic assumption for this particular schedule. So here the first assumption is that addition and deletion are in the same section, so there is no separate section. Whenever we have addition or deletion, I'm using the same section, same row, as you can see, for individual items. So these hold furniture and fixtures, computer and other assets. So these are the initial assets, which is 87,500 which I have spent. And the rate of depreciation is a percentage term, but since this is a straight line method, you can input directly the useful life as well. So this is the breakup of our fixed asset which you have bought, and this is the yearly depreciation. And whenever there is addition, there is a positive, and there is a deletion, that is the gross cost of the asset is deducted, it is a negative figure. And in row 204, whenever there is a deduction, that means you are selling the asset. So $250 we have sold, that is a computer equipment we have sold for $250, and the gross cost of the same is 500. So we have to reduce it, so the depreciation will also reduce in that particular month. Accordingly, if there is an addition, here there is addition of computer as well, and in July we have added more furniture, but we have sold furniture in September. So when there is a selling of asset, we have to have the sell value of the same, which will be cash inflow. Now the second assumption is that addition and disposal are the start of the month to simplify the calculation, because we are not calculating per day depreciation here. We are assuming that these events are happening, that is addition, deletion at start of the month. And the last assumption is that profit or loss on the asset, whenever you are selling, we are ignoring. In ideal world, whenever there is a profit or loss on sale of asset, you have to add it in your P&L statement. But here I have ignored it. The reason why, because I don't want to complicate overall exercise of this particular model. This model is to have a overview of your business over 1 year, and the purpose of this model is to have a operational performance forecast, not your non-business or non-core activities. Like your business is to sell these goods, right? These 4 products you need to sell and optimize your overall performance. Your business is not to sell fixed assets. So that's the reason the detailed calculation for the fixed assets and its individual components like profit and loss on sale of fixed asset is ignored. But as I mentioned, if you want to go in more detail about depreciation accounting and you want to get the most advanced straight line method depreciation model, I will leave a link in the description where you can get the same. Now this is the depreciation, which is a straight line depreciation, which is fixed depending upon the addition or deletion. If there is a deletion, the depreciation is adjusted accordingly. And these figures are linked here in the model above in the P&L statement. As you can see, if you go up, this is row 74 where the depreciation calculation is coming from this schedule. Now that concludes the overall cash flow statement and how you can model the same. Now traditionally, financial modeling exercise is done with 3 statements which are core to any financial modeling exercise. For example, these three statements are income statement, balance sheet, and cash flow statement. Now in this exercise of traditional financial modeling, we need to calculate the cash flow or cash flow performance using indirect method of cash flow, which is more logical approach if you know the finance and accounting basics. In our modeling exercise, we have used cash flow from direct method or direct method cash flow. Here I have used the same because it's easier to understand for any layman or any non-finance or a non-technical finance person. So anybody can understand if you have a basic business knowledge of what is cash coming in, which will be your cash inflow from customers, how much you're going to collect and how much you're going to pay. But indirect method of cash flow is a little bit different, where the cash flow starts with the net profit. Now somebody can argue that the model that is before this up to this particular level is incorrect because you don't have balance sheet, or your overall cash flow from operation or net cash flow is not correct. To prove that the overall method of cash flow, that is this particular method of direct method of cash flow, is working fine, is accurate, I have prepared indirect method of cash flow and balance sheet for this business as well. This is completely automated based on your inputs above. Entire exercise is done, entire calculation is done, and there are error checks as well, which are linked to this main error check. So here we are starting with the net profit of the business, and accordingly we are adding depreciation. We are adding the interest on long-term loan. So here I have a comment why I'm adding it, so you can read through that. And then we have a movement. So indirect method of cash flow takes the movement from the balance sheet. So here I have prepared the balance sheet based on our assumptions in the model, and accordingly I am calculating the balance sheet and indirect method of cash flow. Now I am matching the each and every KPI, that is net cash flow. So first thing we are matching is the closing cash balance, which is matching, and second is net cash flow. So this net cash flow from operations for indirect method will always match with the direct method. So I-230 is the net cash flow from indirect method of cash flow, which ideally should match to our direct method of cash flow. So that is cell 163, that is I-163. So if you go up, our net cash flow is matching. Similarly, operating cash flow is also matching. So 12,865, if you remember, was our negative cash flow from operation in month of January, which is matching, and accordingly each month. So this ensures that our method of cash flow, which is direct method of cash flow, even though it is not directly linked to the net profit of the business, is correct and it makes sense. All these errors are being summed up here, and it should always be zero or very close to zero figure. So if it is like around $5, you shouldn't go and investigate that much. But if it is more than $100, or if it is showing $15, $25, you should definitely investigate to find out what is wrong going on here. Now here on the top we have these key KPIs, which are, I used shapes, Excel shapes, and I have linked the formula from here. So directly cell link is there. I have used some custom formulas with n percentile. I would use the concatenation feature of Excel, and accordingly whenever you change anything, you'll see the changes here right on the top. So these are your key KPIs. You can always add more KPIs according to your business here as well. Now there are various control checks in these models. To ensure that overall model is performing at a highest accuracy, you need to have all these values to be 0. So everywhere we have checks in place, and accordingly your overall error check should always be 0. So everywhere wherever there is a check, I have made a sum and used absolute function to know that overall model is accurate and there are no errors. So this was the model for the new business. Exactly same format is followed for the existing businesses. So you can see the format is same. Only difference is that whatever your existing business data is, you need to bring in here. So this sale is not any assumed sales. This is the actual sales of your previous month for December. And these figures are also actual figures from your actual data. So everywhere there is a blue figures, you need to input it for your existing business. And most importantly, for the schedules, you need to input your actual capex figures here, and also your balance sheet should be actual as well. So The figures for indirect cash flow also should coming from your actual figures and balance sheet as well, as I mentioned. So wherever there is a blue font, you need to input actual figures from your existing books of account, and your model should work just fine, just as explained in our new business model. The KPIs are same, and these are the ranges which you can use. So this is the cash purchase ratio which you are selecting, so you can input many other factors or any other factors you want. This is for the interest rate. This is the frequency for your rent. This is the terms, cash or credit. This is a linear or selective for the growth. Fixed and variable for your cash purchases, which are amount of your cash purchases fixed or variable. These are the days for your credit. So I'm calculating the days, and accordingly the formula is using offset and VLOOKUP function based on this data. Now this section of schedule is prepared to calculate the rentals. So this figure of rental is coming from our model. So this is for the new business model, this is for existing business, and accordingly we are using the simple sum formula to have a quarterly approach or semi-annual approach for your rental payments. This particular table I already explained. This is our overheads based on the sale value or sale volume. This is the dashboard section for existing business. So I have prepared this kind of custom charts, and this dashboard is for the existing business. So this particular dashboard is driven by the data from the model itself. So this is the data preparation section, and these are the charts. So the only difference between the two dashboards is that this has a dark background and this has the white background, or I should say very light gray background. So the first chart shows the performance of the business, that is sales and GP. So this is the actual sales for all the products, and this is the gross profit in blue bar. Below that we have a gross profit percentage and net profit percentage. So each month how much is your percentage of your gross profit and your net profit. Now this green bar represents the highest profit in entire year. So in month of September we had the highest gross profit for all the products, and we had the lowest gross profit in the start of the year because it was our first month of the business. So obviously the performance was not the best. So this particular chart is dynamic, accordingly it will change. So in net profit, instead of September, we have the highest net profit in month of December. So you can usually see how your overall modeling figures are working. And this right side chart is to show individual products. So what is the performance of your individual products? So mobile phone, smart TV, home theater system, gadgets and accessories. So what is their sales overall for the year and gross profit? So sales and GP, and the sales and GP percentage. Exactly same conditional formatting has been applied. So wherever there is a highest, it will be shown in the green bar, and the lowest will be the red bar. Now for this particular scenario, the cash flow performance chart, I have used collection, payments and sales. So how much is your sales compared to that, how much is your collection and how much you are paying. So your sales chart should always be up and collection chart should be right next to it, and your payments chart should be always have some substantial difference to have a positive cash flow throughout the year. As you can see, we had the highest cash flow in the month of February and the lowest in month of January, but then the second lowest was in month of July. This donut chart represents the share of each product, how much we are selling. So the values are converted to percentage, and you can see that highest sale is for the mobile phones, and then the accessories, and then we have gadgets, and then smart TVs, and at last we have home theater system. You can add your own charts as well, and if you find any difficulty in modifying this chart or you want to create your own dynamic chart, please let me know in the comment section below. So these are the data which we are deriving from the model itself. So this is the data I have converted to thousands, and I'm calculating gross profit, so individual products. Now in this particular chart, we don't have individual net profit or gross profit, right? So we didn't model that way. But you can always do that. You can always create additional rows to derive gross profit and net profit for each product. But for sake of simplicity, since we need this only for this particular chart, I have just allocated each overhead. For example, we don't have individual overheads for the direct cost. So if I go here, these costs are not individually segregated. I should go to the profit and loss statement and show you here that these costs are not individually broken down for each product, but you can do the same. So if you apply this percentage to mobile phones accordingly, you will have the breakup of each cost. Similarly, for overheads, you can allocate the same based on the direct cost or cost of sales ratio, which I have done here already. So whatever the cost of sales is, I'm deriving a figure, there is a percentage. I am segregating the same to each individual products. So that's how we are deriving individual performance for gross profit for each product and also net profit. The dashboard, as I mentioned, for the existing business is working in the same fashion. The charts are same. The logic behind is the same. Only that background is dark. And these are the functions I have used in preparing this model. So it's quite simple. There are no fancy or really complex function. Only function you need to take care is the offset function, which I have used. Because offset function is volatile. If your model is quite huge, your spreadsheet will be slower if you use too much offset function. I have used offset function only to derive this dynamic credit days and adjust our collection based on the days input. So if you go here, in this particular scenario, I'm using offset function in conjunction with VLOOKUP function. That's the only place I'm using offset function. Wherever there is a days credit, I'm using the offset function to get the accurate collection according to the credit days. Now, one more thing you should note that there is no circular referencing here because I've designed the model in such a way that we can avoid the circular referencing, which is sometimes important in financial modeling exercise, especially when we have situation of rolling credit or line of credit, which we have here. But I have designed the model in such a way that I have avoided that particular scenario. So if you know about circular referencing, it can cause a lot of errors in the model if you apply the circular referencing in your financial model. So ideally in business world, whenever there is a financial model, any user, or if you represent your financial model for the purpose of analysis to a banker or a prospective investor, if he sees the circular referencing in the model, he might reject your model without even looking at it. So that's the reason I have avoided the circular referencing in this entire modeling exercise. Now, since we have completed the overview of the model, let's see this model in action and check and test the various scenarios. So here, let's manipulate the sales and see how these KPIs are changing. If I change this to selective, my overall revenue is changing by a very substantial amount. If I change linear, the revenue is going down and gross profit and net profit is affected. And cash flow is also affected. Similarly, if I change the gross profit, so for example, if I change this to linear and increase my gross profit by 20%, I will have increase in gross profit, net profit. Now for the purpose of cash flow, if we change this credit days to the minimum possible, which is 30 days, we'll have the ultimate cash flow, like the best performance ever, I should say, of 237K, which is way beyond our net profit. But that is not always the case. So let's make it worst possible. So let's make it 90 days here, 120 days here, 120 days here, and 150 days here. So in this case, from 237 we gone down to 3557 only, and our overall interest cost on LOC has increased. So you can see we have a $2,714 we are paying in the interest cost only. So this is how you can see how your credit period and how your collection on timely basis is most important for your cash flow performance and overall health of your business. So this should never be the case. You should always try to keep a very tight leash on your creditors and ensure that they are paying on time. And you should always design your business model in such a way that you shouldn't extend too much credit to your customers and give them special discount for early payment and employ different tactics to collect your data really fast. This will improve overall health of your business very, very fast. Similarly, if you change your credit period to 30 days everywhere, if I just copy this down, your overall cash flow will go down. And as I mentioned before, your credit terms with your supplier should be the highest. You should stretch your credit period as much as possible without spoiling the relationship, of course, with your supplier. So you have to be rational about it. So try to negotiate that if you're going to buy more products or you're going to buy more volume in a particular month, you need a special credit from them. So that way you can manage your cash flow accordingly. So as you can see, by changing few key important factors like credit days and also credit days from our suppliers, how your overall business is changing and how your performance is. So since we are in a good cash flow position, your overall interest on LOC has gone down substantially compared to the worst situation we saw earlier. So this is how you can model your business performance for a short-term period of 1 year using this kind of cash flow model, or I should say a business model. You need not to be accountant to use this model. As I mentioned, you need to have a basic knowledge of your business, that is profit and loss, income and expenditure. And if you have some basic knowledge of accounting, it will be much easier to understand this. But as I mentioned, that is not a prerequisite to use this model. So anyone can use this model. This model is designed for non-finance and non-technical finance people, or non-technical accounting people, I should say. But as I mentioned before, we have a cross-check with our indirect method of cash flow and also balance sheet. So as long as this error checks is nil, your overall model output is accurate and your data is reliable. So you can present this model to a prospective investor, or if you're seeking a loan, if you're taking a venture capitalist, you can present this model for a short term and get your loans. So if you want to get a short-term loan from a bank or any prospective lender, you can use this kind of model to quickly forecast your overall business performance over next year and show the prospective lender or investor how your business will look like in 1 year. So now the question is how you get this model. The link for the same in the description of this video. So go to that link and you can download this model. And if you have any question in using the model, or if you want to adjust it, I will support one-time changes in this model. So if you have any question or clarification, I will support you. Also in charts, if you want to manipulate or you want to adjust it, I will support it one time. Now if you have any questions or if you need any clarification, you are welcome to ask in the comment section below. And you can find my website link. You can contact me directly via the contact form. Please let me know any questions you have regarding the model, any logic or any suggestion you have to improve the model. I'll be happy to take that input and improve the model. Now, if you want to create this kind of model step by step, you want to learn how to build this kind of model from scratch, there is an entire course which I have developed. The link for the same is in the description of this video. So go there and check it out. There you will find this model as part of the course. So if you enroll into the course, you'll get this model as a free resource. And you can also learn how to build this model from scratch. So you will know each nitty-gritty and each formula how I applied. And also course includes the basics of all these functions as well. So I've explained the basics of these functions. So if you don't have advanced knowledge of this function, you'll have the clarity as well. Also, I'm preparing these charts in the course step by step. So you'll learn the advanced charting techniques as well. Thank you very much for watching, and let me know if you have any questions or if you have any comment. Provide your feedback in the comment section below. Thank you so much.